And welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, we believe is the best way for you to sell highly appreciated cryptocurrency, primary homes, businesses, investment real estate, save a failed 1031 exchange, all so you can defer the tax and create and preserve more wealth. Hey, I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate, financial, wealth, and sometimes tax and insurance minds in the world, where they share their ideas and deal stories so we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming, by the way, on expertcresecrets.com. And if you're interested in learning more about how to use the Deferred Sales Trust to grow your business as well, especially if you're in the M&A world, you're in the business brokerage world, high-end luxury real estate world, or commercial real estate brokerage world, we'd love for you to check us out there as well on our YouTube channel. I'm excited about our next guest. He's out of the great state of Utah, and he's been involved in the financial and investment industry since 2001 and has helped build a multi-million-dollar real estate empire. The mix of real estate and financial planning expertise has enabled him to see opportunities in businesses with more clarity and has enabled him to assist clients to increase their wealth and benefits while lowering their overall risk. He's the founder and CEO of Focus Wealth Group, specializing in wealth and protection strategies, tax-free money planning, and guaranteed retirement income. He is the co-author of the book, Tax-Free Money for Long-Term Care, and is known as a financial coach and mentor to clients nationwide and so much more. Please welcome to the show with me, Barry Brooksby. Barry, how you doing?
Doing well. Thank you, Brett. Appreciate you having me.
Absolutely. Excited to have you on the show and get to know you a little bit more. And we're going to be talking all things about tax strategies using infinite banking. But before we go there, Barry, for our listeners and for myself, would you give us a little bit more about your story and your current focus?
Absolutely. So 21 years involved in the industry. And what I found initially was putting money into the traditional financial advice of Wall Street, mutual funds, 401ks. It wasn't working for me, and it wasn't working for a lot of my clients as a financial planner. Clients would come to me and say, why aren't I earning great returns, or why am I losing money in the market? And it really caused me to look and find something better. I wanted guarantees. I wanted tax-free use of money. I didn't want the volatility and all of it the market offers. So I got into real estate very quickly, and then also coordinating real estate with these high cash value infinite banking policies to grow money tax-free. I work with clients all through the country, and my life is much better because of it. I don't have to worry about the volatility of the Wall Street investments or the Wall Street dollars. And frankly, me and my clients know what we're going to have in retirement rather than hoping and crossing our fingers for some returns that frankly are unknown.
Excellent. We'll dive into that here in a minute. And I want to take one other step back, and I want to go back perhaps to your college or high school days, maybe the earlier days. I believe we've all been given certain gifts. Some people call these superpowers. Some people call them strengths. And I believe they're God-given gifts, and they're given to us to be a blessing and help to others. So I'm curious, what are those one or two gifts that you believe you were given, and how does that help how you help and bless people today?
Yeah, thank you. Well, I'm a musician. My background is actually music. I've played guitar over 35 years. I've got an album out there on iTunes. So the gift of music, I feel, has been a God-given gift to me. I love to create and get out there and share my music with the world, have another album coming out next year. But also, I find that I'm very passionate about helping other people. What I do in my world is a reduced commission type of product. And I get asked from clients all across the country, why do I do it? Why not make more money and increase your revenue more? Frankly, I love to help people. And what I have found, Brett, is that when you help other people, you're going to make more money along the way. Don't chase the money. You want to chase helping people. That's really what I've learned in my practices. The more people you help, the better your life is going to be. It's karma, right? You reap what you sow. What comes around goes around. Those are gifts from God that we shouldn't be taking for granted. We should be helping one another.
Beautiful. Love that. Helping people, passionate about helping people, and then having the musician in you, or the gift of music in you to be able to create. Is that a fair summary?
Fair summary.
Awesome. So now let's dive into how that fits into tax strategies using infinite banking, right? Which is kind of cool. I love the creative background and the helping people part of it. So, what's the number one secret to tax strategies using infinite banking? Where should we start, Barry?
Let me start with the foundational background. Most people saving and investing for their future, retirement, whatever it might be, are following the model that Wall Street puts out there of 401ks, IRAs, right? Everything that's government oriented qualified plan. The problem that you see with those traditionally, which by the way, most wealthy people don't invest in those, they're investing in real estate and their own business. But a lot of Americans invest in those qualified plans. The problem with the 401k and IRA, number one, is they are volatile. The market goes up, the market goes down. I'm reminded, obviously, of the crash of 2008. People lost 20, 30, 40% of their portfolio. And it took over a decade for a lot of those people just to recover to get back to even. The second problem is those investments are traditionally high fees, meaning a lot of the money or growth can be eroded from the fees that are being charged. And whether you make money or lose money, the money manager, the financial advisor, Wall Street, they're still making money. And then the third biggest problem is it's tax deferral. And I hear from CPAs often that it's a tax savings. Put money in a 401k or IRA, you're getting a tax savings. That isn't true. It's a tax deferral. What they're doing is they're kicking the tax can down the road to pay the tax later, and more than likely, they'll be paying higher tax. There's many reasons for that, but chances are they'll be paying higher taxes compared to what they would be paying on today. What I advise people is in a high cash value infinite banking plan, we avoid all the problems. Number one, you grow money guaranteed. You don't have to worry about volatility, and you're earning interest and dividends on an uninterrupted compound interest growth curve. Two, the fees are about 10 times less than what you would pay in your 401k or IRA. And three, it's tax free. Now, there are some things we have to do to keep it tax free, and that's my expertise to make sure people follow that plan, a properly structured plan. If done correctly, not only can you use the money throughout your life to invest in real estate, to buy other investments or invest back into your business, but then in retirement, you now have built up a large bucket of tax-free money that you can then draw on as tax-free retirement income.
God, let me make sure I caught that. So the number one secret to infinite banking is understanding that Wall Street is not the best way with 401ks and IRAs and qualified plans. One, because it's really volatile. Two, because of the high fees. And three, it's only tax deferral. It's not tax free or more efficient. And there's likely to be higher tax in the future. And whereas this infinite banking structure strategy, you can grow money guaranteed. You can earn interest and dividends, and it's about 10% less in taxes. And then if properly structured, it can be tax-free. Is that a fair summary?
Yeah, 10% less in the fees that you would pay in that type of plan compared to a qualified plan. And you are growing money tax-free, yes.
Excellent. Okay, so let's talk about that. So what's step number two? So once you see that that's the challenge, and then what the goal is, what would be step two to setting this up or getting it going?
We always look at a client's numbers. I want someone to see exactly how this plan's going to work for them. No two plans are exactly the same. So I'm looking at what are your goals, age, health, income, what do you want to achieve in the future? Do you have plans where you want to take policy loans early on to go invest in real estate and use policy loans for down payments? What do you want to see as far as retirement dollars? Most people, if they're investing in qualified plans and all their income in retirement is going to be either taxable or tax deferred, I often ask this question. Think of these three circles in your mind, and these three circles would represent buckets of money: tax deferred, taxable, tax free. Which bucket do you like the most? 100% of the time, people tell me tax free. But the next question is telling. Where's most of your money? And people answer 9 out of 10 times tax deferred. There are taxable buckets as well, like real estate and CDs, etc. But most people want tax free. But when they look at their portfolio, Brett, they have very little, if any, money in the tax-free bucket, but it's what they want. So we go to work on designing a plan for them so they can see their own numbers.
Excellent. So let's talk about that. So let's say someone has $1 million in the bank and it's sitting there. You already either paid taxes in it. So that first scenario, and it's sitting in savings, and they could put it into something that's going to grow tax-free, perhaps infinite banking, something that could be like real estate that does have some taxes, but if you have some depreciation, you can offset it, but then you can also trade it tax deferred. What would be the scenario in which you would say one versus the other? What would that look like? Why would one use one versus the other?
Yeah, well, let me say, I'm a 16-year real estate investor myself. I love real estate, but it's not the be all end all. I think that someone should have real estate in their portfolio if they have a flavor for it. In other words, not everyone that's in retirement or approaching retirement wants to deal with real estate, but those that do, I think it's a wonderful opportunity throughout your life and then a real estate play. The benefit that you get with infinite banking as compared to real estate is the infinite banking, these cash value policies are fully guaranteed. There is no volatility. You don't have to worry about the market or real estate market coming down or going up. You don't have to worry about tenants and management. It's basically a set it and forget it. And that set it and forget it plan is working for you every day. You're growing uninterrupted compound interest. So me personally, I like both. I want the benefits of real estate. I want that tangible asset. I want the cash flow, but I also want the infinite banking cash value plans. One, because I want to grow money guaranteed and tax-free. But here's what I do. I borrow money from my infinite banking policies and encourage clients to do the same, to go buy more real estate. We do that because when you take a policy loan from an infinite banking plan, the life insurance company doesn't physically remove the money from your cash value. You're still earning interest and dividends on your total cash value, even though you have a loan. So money's working for you in two places. You own the real estate, get the cash flow, and you're making money also in the infinite banking policy.
Got it. Okay, so let's unpack that a bit. Okay, so you have $1 million, and so you would fund the uninterrupted compound interest. So I guess the first question would be, what is the guaranteed rate typically on average? Let's just say the person's, 55 and they're worth $5 million and they got a third of it in the stock market, a third of it in real estate, and a third of it in a business they own. And they have an extra $1 million there, and they're doing very well. And they're saying, well, okay, I could fund this $1 million into this policy, and it could be uninterrupted. What would be A, the guaranteed rate, and then also B, quickly on the general cost?
Yes. The guaranteed rate on policies today is 4%. In addition to the guarantee, there is a dividend that's paid. We use companies that have been in business over 145 years. These dividends also are reinvested back into cash value. So I tell people, this isn't true all the time, but just historically on an average, it's about 5% tax-free. So if you look at that from a market-based investment, you'd have to earn somewhere between 8 and 10%, depending on your tax bracket, to net a 5% tax-free return, which is remarkable. And then the cost to set up a policy, you simply make a premium payment. So I have clients across the country. Some clients are putting $5,000 a year into a policy, and other clients are putting $50,000 a month into a policy. So it really depends on your certain scenario. In that $1 million example, if that client came to me and said, I want to invest in real estate and I want to invest in a cash value policy, we would look at taking somewhere between $25,000 and $50,000 of that per year over a 7 to 10 year time frame, and then be done funding. That money is growing tax-free, and then they've got the remaining portion of the portfolio to go buy real estate.
Okay, so I'm going to make sure unpack that now too. So you said about 4% is the guaranteed rate plus a dividend, which typically 1%. So that's 5% tax-free. So let's imagine I just put all $1 million into it day one, and I'm getting 4% on my money plus the 1%. And the equivalent to that would be 8 to 10%, and then netting 5 on a different return. I think you said that too. But if I'm borrowing the money to what am I borrowing at, or is it, I guess, margin secured against the amount? Because I know you said it's still earning, but what would be the net effect there? What's the borrow interest rate at?
Yes. So the borrowing rate is 5%. So what I tell clients is at face value, it's a wash loan. You're borrowing at 5, you're earning 5. Here's the difference. When you borrow at 5, let's say you're cash flowing on a real estate deal because you put that money to work, you took the loan, you now own a cash flowing real estate asset. You take a portion of that cash flow to pay back the policy loan. But because the cash never left your policy, you're earning the 5% on a compound number. So when we look at the difference side by side, the loan is principal reduction. You're paying that loan down, and because you're reducing the principal balance of the loan, you're paying less interest over time. Whereas on the other side, you're still earning compound growth on the total cash value. At the end of the day, and I've done several webinars on this, you come out ahead because of that compounding effect.
Yeah, interesting. And by the way, you can learn more about Barry Brooksby at focuswealthgroup.com. That's focuswealthgroup.com. And I encourage our listeners, we're getting a little bit into the weeds here, which is good. Hopefully you guys are appreciating it because it's interesting to look at, right? Because my background's multifamily investment, real estate, right? And part of the play there is you put the down payment down, right? Let's say 35%. And let's say it's $1 million on, let's just say a $3 million deal. Rates are about 3 to 3.5% right now, fixed for 5 years, and then it floats, but on 30-year AMs. And then, of course, you get the cash flow. And then with the cash flow, you're able to pay the debt service, but you also get the depreciation. So oftentimes, especially if you do what's called cost segregation, you can accelerate that depreciation. And oftentimes, all of that cash flow, you're paying zero tax on that for multiple years. And the thought is, if I can do rule of 72, earn 7 to 10, 7% over a 10-year period, we can double that amount, and then we can tax defer that into it via a 1031 exchange. So walk me through what I'm missing there, Barry, on why I wouldn't just take the $1 million down, borrow at 3.25, right? Use the depreciation on that asset to offset the cash flow. What am I missing there? Why would I not just do that versus first starting the life insurance policy and then borrowing against it to go? By the way, can I get the full $1 million out on the borrow against it, or is there an LTV limit on the life insurance policy?
Good question. And by the way, I love the strategy you just mentioned. I'm all for that. You can borrow up to 95% of your total cash value in any year, even in the very first year when you start the policy. A few of the differences are, obviously, in the real estate deal, we don't know exactly what the future holds. We can make the projections, but there's no real guarantee. But I love real estate, tangible asset. If you do it right, you're going to be okay. The infinite banking policy, you are getting a guarantee. If you can borrow money at less than 5%, I usually recommend that. However, here's what most real estate investors do, Brett. They'll use cash, like we're saying here, for the down payment. When you use cash, there is a lost opportunity cost. Sure, you own the real estate, but what if you pull the cash out of another investment? Savings account isn't really a very fair example because savings accounts are paying 0% basically. But when you take cash elsewhere, you're no longer earning any return off of that money. So that lost opportunity cost can be a cost. In a life insurance policy, when you take a policy loan, because you're still earning interest and dividends on your total cash value, there is no lost opportunity cost. So I would run a side-by-side comparison and first say, hey, if you can borrow money at 3.5%, you should probably do that. But knowing that your effective return or cost for the loan is zero, and you're still coming out ahead because of the compounding, chances are, even at a 4 or 3% loan rate, sometimes paying 5% simple interest is better than paying 3 or 3.5 or 4 on an amortization schedule. I lost your audio.
I'm back. Sorry about that.
There we go.
I was on mute. No, I think it's really interesting. I think it'd be good to see those numbers side by side and run those. And it would be also great to speak with multifamily syndicators that are doing this on a big scale. I'd love to see those numbers, like on a 100-unit or a 3-unit apartment complex, even bigger numbers. That would be really helpful. The Excellent. So now I want to shift a little bit there. And any other last thoughts on the infinite wealth banking strategy that we haven't touched on yet so far that you wanted to make sure we touched on?
Maybe we'll go into the weeds just a little bit here further.
Yeah.
Most investors buying real estate, they are amortizing. When you look at the cost to amortize and the majority of your payment is going to pay interest, that really over time can hurt you. So my point is, by using a policy loan and it's simple interest, there's a big deal there. And looking at the numbers side by side is very compelling and convincing to say it does make sense to take a policy loan for down payments. Maybe we don't amortize the whole thing. Maybe we amortize only 50, 60% of the loan and use the policy loan for more of a down payment with simple interest. I find in that scenario, you're coming out ahead or further than you would otherwise.
Yeah, I'd love to see those numbers. That'd be great to really dissect that. So moving to the tax deferral part of it, I want to push back a little bit on that. I'm curious what you would think on this. So we help people who are selling highly appreciated cryptocurrency businesses, primary homes. I'll give you the cryptocurrency deal we just did, and I'm wondering what you would do on this one. So they bought it for $100,000, and Barry, it's worth $13 million. This is Ethereum, okay? And they sold the first kind of tranche of it for $5 million, and so their gain is really big, and it's their tax was somewhere around 30%, just give or take, okay? And so they're looking at about $1.5 million liability on that. And so they could not only sell and move it into what we use is called a deferred sales trust, but they can also defer the income tax on that too. So they don't need to take the cash flow right away. So they can lower their income tax bracket, which otherwise would have been through the roof. And then what they can do too is they could go and they could use a portion of that to invest into real estate, all tax deferred, and then get all of the other benefits I was talking about, depreciation and all those other things. So, and the way we put it too is most of our clients like to pay the tax the second day to never, meaning that they're never going to touch the principal, that $5 million, and they're going to use it to build more and more wealth. And the rule of 72, if you're in 7% over 10 years, that 5 will turn into 10. And that's typically what we're doing. Now, the interest payments they'll pay ordinary income tax on for any depreciation they don't have. But in the premise of, well, taxes are going to be higher in the future. And by the way, we do get that sometimes. People go, well, Biden's might be doubling from 20 to 40. And we say, yeah, and you might be paying 30 to 50 now and maybe 50 to 70 later. But either way, I wouldn't want to pay 30 to 50 now or 50 to 70 later. So I'm just curious on your thoughts on that. What am I missing there on, hey, just pay the tax now, don't defer?
Correct. I like the DST. I think what you guys are doing is fantastic. What I would say is that initial 100,000 that person invested to earn 13 million, one, it's remarkable, but two, it would have been great if he would have had the $100,000 in the infinite banking policy to then go purchase the crypto, that he would still be getting growth on 100,000. Now you say, well, there's a $12.9 million effective gain potentially. The DST is fantastic. We wouldn't be able to take that money directly and put it into the infinite banking policy because they would have to pay tax on it now. And then whatever goes into the policy is then growing tax free. My point on the tax deferral is when it comes to IRAs, 401ks, any qualified plan that we see traditionally put out there by CPAs or Wall Street, that they're not explaining the full story to the person investing in that particular vehicle, that they're not recognizing, man, when I take this money out, it's 100% taxable and I have to take it out. There's got to come a point where I've got to take that money out. And if I die with those investments and I haven't taken the money out, my kids have to pay the tax. So tax deferral isn't all glorious as CPAs or tax accountants make it seem. I want to make sure that people have a portion of their portfolio tax-free, not 100% tax deferred.
I'm so glad you clarified that because I couldn't agree with you more, right? And that's part of why I stopped doing, my wife and I stopped doing 401ks, stopped doing IRAs, right? Because we said at a certain point, they're going to A, force us to get out of it to take the income. And then B, we have to wait to a certain age or we're going to get penalized. And I said, why don't we just buy real estate and invest in businesses and get the cash flow now because we can potentially retire earlier, 5 or 10 years earlier, and spend more time with the family, the kids, and everything else, and travel, do the things we want to do versus being locked into this thing. And so, especially if it's not as flexible, now there's self-directed IRAs and different things you can do, but there's also some rules on that with real estate and different things that make it more complex. So I completely stopped. This is about 10 years ago. I'm like, okay, I'm not going to that anymore. It's 100% going into real estate. But if I'm hearing you correctly, you're saying had the client had that $100,000, let's say in a infinite banking life insurance policy, and then invested it or borrowed against. I'm not sure how you would do that and buy the crypto. Maybe walk me through that. Are you saying that it would be tax free to the 13 million, or can you walk me through that? What am I missing something there, Barry?
No, I wish that were tax free.
Okay.
Any outside investments that you do other than the infinite banking, you still have to go through the normal tax implication.
Got it.
But that $100,000 will continue to grow tax free. So let's look mid to long term. 10, 20 years from now, that 100 grand has grown. There's gains on the 100 grand. But when he took the policy loan, the growth on the 100,000 wasn't affected. So here's an example. I talked with clients today, they're in their 60s, and they said after we talked, wow, I wish we would have known about this 20, 30 years ago. Mm-hmm. The compounding effect on these dollars inside the plan are obviously exponential the longer the time frame. Mm-hmm. So no, there is no tax benefit as far as the extra growth on the crypto, right? But had he taken it from the policy itself and then continued to maybe buy crypto throughout his life or real estate throughout his life, he's still growing money in a tax-free bucket.
And then just to clarify, he's borrowed against the 100,000 to go buy the stuff. Let's say 95,000. So in this scenario, he put 100 into Ethereum, but instead he would have put, let's say, and I don't even know what the fees would be if you started $100,000. We're assuming it's net.
He would have 95,000 of that.
Okay, so 95,000 after fees, and then 95% of the 95,000 could be borrowed against to go buy the crypto. Is that right?
That's correct.
Okay, so there is that we'd have to do that math to say we're losing about 10% purchasing power. Is that fair?
In the first year.
In the first year, okay.
That's right. But what happens is that cash value grows over time. Mm-hmm. There's more money in cash than you've paid into premiums.
Got it. And what point do you typically see that past that 10%?
It depends on the age of the client and the health. We can see a break-even point anywhere as soon as the 3rd year up to about the 7th year.
Okay. 3rd to 7th. All right.
Yeah.
Excellent. This is good. This is cool. I appreciate you going into that, Barry. So, but which leads me to my next question, which you've touched on a little bit, but I'm wondering what your biggest frustration is when it comes to capital gains tax deferral and the 1031 exchange. You kind of talked about deferral a little bit, but anything, it could be, we also more love the deal stories, right? So it could be yourself, it could be a client, it could be a friend or family member. Like, is there like a deal story where you're like, oh my gosh, Brett, this was so frustrating. We wish you could have done this or that, but is there anything that comes to mind there, Barry?
Yeah, several. I mean, I've had clients in my real estate background for the last 16 years is what I see most often are people getting frustrated because they can't identify a property to go do a 1031 exchange with. So what do? They have anxiety and they go make a bad decision and they get into a property that they maybe shouldn't have got in or wouldn't have got in under different circumstances because they want to avoid the tax. So one is they're making a bad decision. What I often will tell them is if you're earning 4 or 5% tax-free in the infinite banking policy, there's less anxiety. But from a 1031 perspective, that's what I see over and over again, is people having the fear of, I've got to get this money to work. I've got to find another property. And if I don't do it in the right amount of time, I'm going to end up paying the tax, which I don't want to deal with.
Yeah, we call that the shotgun wedding, Barry, right? If you ever see someone, one of your friends, they get engaged quick and get married quick. That's oftentimes, especially when you have a marketplace like this, where the prices are so high,
Yeah.
interest rates are so low, it's just driving them up. And there's a lot of money chasing fewer and fewer deals, especially value add forced appreciation deals. And people, have to identify in 45 days, get married in 180. And yeah, you're right. They're letting the tax tail wag the investment dog. And in fact, in 2008, this is where people got hurt. They had too much debt, too much liability, not enough liquidity, and they had overpaid. And they knew they were doing it in '04, '05, '06, '07 until the music stopped.
Yeah.
But some of them lost half, some of them lost everything. And we're going, gosh, what is it worth it just to defer that tax, right? And obviously the answer would have been no. You would have just, paid the tax, you paid off your debt and just waited for the market to shift until a deal made sense. Enter the deferred sales trust. This is why we love it. You get the best of both worlds. It's like the Netflix to the old Blockbuster way of doing things. You can sell high, defer the tax, pay off your debt, diversify, get liquidity. By the way, you can fund infinite banking life insurance policies with the income off of it. And you can. There's also some creative other ways to potentially fund some insurance policies, which is really incredible. So you can do both combined, which is powerful. And then, but then you can buy real estate whenever you want. In fact, we have a client who just did a deal. They sold a $2.6 million business, and they deferred $600,000 of tax, and they're building 70 multifamily units, all tax deferred in Tennessee.
Nice.
And this is ground up development, which again, 1031, equal or greater value. It has to be like kind. It has to be in a short period of time. It wouldn't have been possible because A, he's selling a business. B, it's taking him a year and a half or so to build the units, and so the flexibility and like I like the way you put anxiety, like it just kind of goes away. We have to say we're like the safe harbor. Why don't you get a little bit of insurance, get a little bit of the stock market, get a little bit of hard money lending, get a little bit of real estate, and let's just take the stress way down, right? Versus selling one asset for 10 units and moving for 20 units, and now you're all not diversified. Any thoughts on that, Barry?
Yeah, you bring up a valid point. I like diversification. What I don't like is how it's sold in the traditional financial world. Wall Street financial advisors, they tell you to diversify, but everything's still in the market. It makes no sense. True diversification is having different asset classes. So we're talking about real estate, we're talking about business, we're talking about cash value infinite banking, we're talking about maybe some market investments. That's true diversification, different asset classes. And in doing that, I believe it brings more peace of mind to a person. There's more or less sleepless nights. There's more flexibility. We've used that word, I think, a few times here. And ultimately, when they get to the end, I talk to clients all the time about you want multiple streams of income in retirement, not just one. Unfortunately, most people today are banking on a single 401k for income and Social Security. Let's not do it like that. What the wealthy do in this country, real estate, their own business, some market-based investments, maybe stocks, and high cash value, whole life insurance, tax-free.
Beautiful. Thanks, Barry, for sharing that. By the way, you can learn more about Barry at focuswealthgroup.com. It's Barry Brooksby at focuswealthgroup.com. And you can learn more about the Deferred Sales Trust and how to eliminate the need and all this anxiety and stress of selling cryptocurrency, businesses, real estate. We can save a failed 1031 exchange. We've done about 7 of these in the past 40 days. We'll close another 7 in the next 40 days. And we're doing businesses, crypto, primary residences, right? Luxury homes, investment real estate. You can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com to learn more about that. All that being said, we're running out of time. So Barry, are you ready for the lightning round?
Let's do it.
All right. Knowing what you know now, Barry, if you could go back to your 25-year-old self, what's the one golden nugget you'd make sure to tell yourself to do?
I would have started saving money earlier. Absolutely. You don't see that when you're 25, but I really would have started chunking a lot more money away, either in real estate or these tax-free infinite banking plans.
Beautiful. Second question. What's the number one book you've recommended or gifted the most in the past year?
Yep. Easy. Robert Kiyosaki, Rich Dad, Poor Dad.
Love that book. And by the way, why don't you plug your book real quick too, Barry? What's the book you have on?
Yeah, so some of my planning is long-term care. Long-term care obviously can be very expensive, 10, 12, 15, $20,000 a month for the care. There are tax-free strategies to take qualified money, turn it into tax-free money for long-term care. I wrote the book because those people out there 65 or older, 3 out of 4 will need long-term care. And guess what? The costs are only going up every year. And rather than depleting your own assets or your real estate portfolio or your brokerage account, you can actually have tax-free money paying for your long-term care 2, 3, 4, 10 times the amount that it actually cost you to have. It's pretty
Beautiful.
remarkable.
Love it. What are you most curious about right now?
Gosh, for me as a musician, I'm always looking at music, guitars. I'm curious about the future of my own music, frankly, but I'm also curious about what our world has coming in regards to America. I think this is the greatest country on the planet, but there are some decisions being made that worry me some, but I am an optimist. I believe in abundance thinking, but I am curious to see what the future holds, which is another reason why we should all be planning and preparing for an unknown future.
Amazing. Barry, for our listeners who want to get in touch with you, what's the best place for them to find you?
Yeah, focuswealthgroup.com. They can also email me, barry@focuswealthgroup.com. And I would encourage people look at their own numbers. If this is intriguing to you, let's put a plan together, no obligation, but look at your own numbers. It really gets powerful when you begin to see how this strategy can benefit you, your family, and frankly, allow you to leave a larger legacy behind as well.
Barry, it's been more than a pleasure. I want to encourage you to keep using the gifts of being an amazing musician, creating solutions and strategies and music for people, right? To enjoy and have more prosperity, more wealth. And also want to encourage you to keep helping people and being passionate about helping them. And I thank you for being on the show. And also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, or getting with Barry Brooksby to get some infinite banking, perhaps life insurance going, to get some really cool stuff that we just all talked about. If you know a friend or a family member who is selling and highly appreciated real estate, business, cryptocurrency, would you do me a favor? Would you share this with them, this episode, and or just our website or anything, so that they don't get hammered with tax when they sell, and then I get calls every day. Hey, I just sold. Can I do something? I'm like, no, it's too late. Unless it's in a 1031, then we can save a failed 1031. So again, you can go to capitalgainstaxsolutions.com to learn more about that. Remember, we're also streaming on expertcresecrets.com. And again, M&A advisor, business broker, luxury real estate agent, commercial real estate broker. We'd love to love for you to check out what we're doing to grow that business and help more people out as well. Thanks so much, everybody.